If there's one thing that raises the collective ire of reverse mortgage professionals, it's scammers who financially and emotionally victimize older homeowners. A particularly egregious case came to light again in Chicago when resident Mark Diamond was sentenced to 17 years in prison. His punishment couldn't come soon enough. Diamond has a long and checkered history of mortgage fraud. As early as 2003, he was banned from conducting loan closings in the state of Illinois. But that didn't stop this determined fraudster. Diamond was later banned from any mortgage transaction in 2015. According to court documents, Diamond ran an elaborate reverse mortgage loan scheme between the years 2009 to 2016, soliciting home repairs as a contractor and then tricking them into a reverse mortgage. He preyed primarily on elderly minority residents in Chicago's West Side. Diamond's crimes were so heinous that many relatives claimed the convicted con man didn't only take their relatives' money, but their lives, claiming the subsequent stress killed their loved ones. The scale of Diamond's crimes has the Illinois legislature drafting a new bill that would protect senior homeowners. House Bill 5506, known as the Senior Home Preservation Act, would provide grants to local agencies to fund minor repairs and rehabilitation work for low-income senior homeowners. The bill has already gained bipartisan support in the legislature and waits to be moved to the state Senate. On January 15th, the Consumer Financial Protection Bureau issued a report reviewing home equity contracts. U.S. homeowners have over $35 trillion in home equity, making it a significant source of household wealth. People who want to tap into their equity may sell their home or borrow money using common options like cash-out refinances or home equity loans. However, some consumers are turning to complex financial contracts offered by financial companies and backed by Wall Street firms that are interested in their high returns. The CFPB, like many regulatory agencies, is typically a step behind innovations in financial products. The report focuses on HEI, or home equity investments, which gives the homeowner a cash payment in exchange for a lump sum repayment, and that's going to be based on part of the home's value. Not unlike a traditional or reverse mortgage, the homeowner under these contracts remains responsible for making insurance and property tax payments. These products typically have terms that range anywhere from 10 to 30 years. Now, similar to a reverse mortgage, the loan's balance grows over time until the homeowner moves or the contract is terminated. Now, where these equity sharing companies are likely to get into hot water is advertising. The CFPB noted, advertisements for home equity contracts tout large upfront payments and claim home equity contracts are not debt. Marketing websites state that the home equity contracts have no monthly payments and no interest and are available to homeowners who have no income and low credit scores. Similar claims led the Washington State Attorney General to file suit against Unison, an equity sharing company that claimed that their product is not like a reverse mortgage because it's not debt-based. Now, as some reverse mortgage lenders have learned in years past, any future obligation to repay is a debt. And most importantly, a reverse mortgage never eliminates debt. It simply reconstitutes it into a non-recourse optional pay loan. Other concerns noted include the ultimate repayment amount being unpredictable, with the CFPB saying each company uses their own methodology to arrive at an ending balance. Under many contracts, the settlement amount grows at a rate of 19.5% to 22% per year in the early years, which is substantially higher than interest rates on most home secured credit and somewhat less than the interest rates on unsecured debt like credit cards, said the Bureau. We've included a link to the CFPB's report in the show notes for your convenience. This week, John McHugh from Reverse Market Insight returns with our monthly Reverse Mortgage Market Minute. Now, John, I understand you have something that's a little different for our listeners and viewers this month, so take it away.
Well, hey, Shannon, thanks for having me back again. I know you and I are having a conversation about kind of the lack of data from HUD right now, and a lot of that has to do with the transition that's happening in DC at the moment. And for our purposes, what's happening with HUD and everything else like that. So data has been slow to come out from HUD, at least any new data. So instead, this other webinar you and I are working on together, you thought that some of these slides would be interesting to your viewers. So I wanted to kind of share some of this stuff, which will kind of wrap up 24 mostly, and maybe get us into 25 a little bit. So on this first slide here, what we're seeing is an average of the CMT, average monthly of the CMT, going all the way back here to January of 22, taking us up through October of 24. And I stopped at October 24 because that is where the HUD data stops. But we can definitely start seeing, as many of us have lived through, the interest rates increasing over the many months here, and how that has applied to case numbers. So we've seen total case numbers decrease as rates increased. We definitely saw HECM refinances plummet. One of the things that's really interesting here is, regardless of low interest rates or higher interest rates, purchase stays more or less flat. Even new equity, these are brand new reverse mortgages, they stay relatively flat. They have some fluctuation, right? But given the fact that, we're down to close to, 1 and let's call it 3/4 or something like that, jumping all the way up to nearly 5, we don't have that same kind of fluctuation in case number assignments that you would kind of expect with such a rapid rise in rates. In fact, where we see some of the changes, where we see these rises in rates, we do see dips in overall case numbers, but the dips, even the dips, aren't nearly as severe as the increases in rates. And conversely, when we take some of these dips in rates, we do see a little bit more of an uptick. So we actually see a slight little bit more of an uptick in some of these drops than we do in the drop in case numbers with the increase in rates. And we can even see here where we're seeing a pretty steep decline in rates before they started going back up here. In September, we see this pretty significant drop, but it's still much higher than where we were back in January or even October, of 22, right? But we're starting to see a much steeper increase in applications, in overall applications, and in new equity, and a slight bump in, I know this is a little hard to see, but even a slight bump here in refis. And again, purchase is still just kind of staying flat. What this is telling me is that new equity is always the place to be. So for loan officers, this is a great place to continually kind of pick up business. This is our core business. Refinance is not the core business, but also it's also telling us that we're kind of in this new norm, right? If rates are ticking up and things aren't moving too much, this is also kind of telling us that we're kind of hitting this new normal, a new acceptance of where the rates are at. So we always talk about this every single month, why are case numbers important, and we always talk about how they're the earliest indicator of both fundings and endorsements. We've seen an uptick, as we've been mentioning, here as we go into the fourth quarter for these 4 months of July, August, September, and October. We've been seeing this, essentially, again, kind of going back to, maybe we're starting to get into this new normal. Maybe we're starting to have some acceptance of that. I know that it's hard to see that, but when you start seeing the rates versus applications and seeing how, we're not quite seeing that same rise and drop that you do with the rates, that does give us some sense that, the market is, accepting and becoming a little bit more in that normal range. Then I wanted to kind of take a look at the last 4 years of where endorsements have been and how the breakout has been, right? So we saw those lower interest rates. So we saw a lot of HECM purchase. I'm sorry, HECM refinances. Purchase has always stayed pretty much the same, and new equity has always been a significant share, right? So even in these lower interest rate environments, it's always been the larger share. In 23, when rates began to really climb, HECM went down. Purchase, as you kind of see here, it's been relatively similar. But new equity, it's kind of like on par with 21, right? Even as we look into 24, now again, data only goes to October as far as the breakout goes. So the black is the volume for November and December. I just don't know how they break out as far as these categories are concerned. So I wanted to make sure I captured the entire amount, because we essentially ended the year for 2024 at just under 27,000 units, so 26,834. So just about 3,000 units shy of where we were in 23. So kind of where did we lose those 3,000 units between 23 and 24? Because I don't think it was fully rates. I mean, that had to play into it. I mean, obviously that plays something into it, right? But until I kind of get, where, the breakout here of how much of this, did we lose much in did we lose any really in the new? Was it more in the HECM refinances, which I think is where some of that was, maybe some more in purchase. And then the only thing we also don't have a good visibility on is what percentage of this might have been coming or going to proprietary products as well, right? So, the volumes might not have been really that down from 23 to 24 without the full knowledge of proprietary and exactly how much of that may have taken over there. The other thing I wanted to kind of share, because I know that kind of a larger audience here for Shannon and HECMWorld are brokers, and we constantly talk about how can we make an impact, and brokers, you guys can really make a huge impact on driving volume. This is a report that we do here at Reverse Market Insight, kind of talking and showing brokers, and we put them in these buckets. So these are brokers, and we're looking only at TPO brokers, and we're looking at the same production as we were just looking at 21 through October 24. So it's the exact same. So we look at brokers who are doing 0 to 1 loan a month, 2 to 5 loans a month, so on and so forth. And how many loans in this time frame from January 21 through October 24 has each bucket done, and how many brokers were in there, right? Now, I understand that some of these brokers might not be doing reverse right now. Some of these brokers might have gone out of business at the moment. But in this time frame, we have had almost 4,100 brokers in the 0 to 1, doing 0 to 1 loan a month. So you had to have done at least 1 to 12 loans a year to fall into this bucket, right? I mean, if we could move this needle to where all these people did 1 more loan a month, or one more loan a month, 1 more loan a year even, right? That would make a significant impact. That would have put 24 over 23 if every broker. Now, keep in mind, when we start looking at this more on a 12-month basis, this number for brokers for 0 to 1 moves, and it's a floating number, but it floats around 1,800 to 2,000 when we're looking at this in a 12-month period. But even if we said 2,000 brokers fell into this, and this stays around the same 100 and something, right? So we're still, around that 2,000 mark regardless. If everyone just did 1 more loan a year, that still would have put us much closer to being even with 23. I mean, just these 2 buckets alone make up 96%. Sorry, 96. Make up 66% of all the volume, right? But they make up 99.4% of all the brokers. 99.4% of all the brokers out there are doing 66% of the volume. Okay, that's during this time frame. If we look at shorter time frames, it's still very high. Volume shares are usually hovering around 50%, and the broker shares are still over 90+% for these. So, considering the fact that this is where we have a lot of opportunity for growth, these are people who can make significant impacts, in our overall annual volume if we can just help people get to 1 more loan a year even. And the last thing I thought I would share with you is kind of where we're seeing average ages and average utilizations and trying to explain this. So again, I'm putting this together for a different webinar. So I use the LTV here, but this is principal limits. So I wanted to show kind of the difference between a 5.5 expected rate and a 7% expected rate with a debt payoff of $175,000. This is kind of looking at a $5,000 home, but essentially, regardless of rates, right? The debt payoff, the need, if you will, it doesn't change, right? The amount of money that a person needs is still going to remain the same regardless of rates. So when we're at the 5.5 expected rate, we can easily pay off this 100,000 and have plenty left over. But when we moved it to 7%, we can see, even at 67, they're gonna have to come to closing with some cash. It's not until we get to 68 that they start having a small line of credit, right? So what we're actually seeing is that the average borrowing age right now is around 75, and average utilization is also around 75, because we're starting to see utilizations either between 60 all the way up to 100%. Which is putting us at that average of 75% utilization. But this is, just kind of helping us understand, how, this move in rates, where it is making this a little bit more challenging to qualify people, perhaps even helps you understand, the age demographic that we should be looking at. But also, just if we're going to be able to help these younger borrowers, we need to have different strategies. There's just different things that need to happen in order to help these younger borrowers. So anyways, I just thought that would be something different and interesting. And again, thanks Shannon for having me on again, and thanks for the idea to share this data with your people. So until next month, we'll talk to you then.